Greetings, this is Dr. Jeffrey Scott, and this is my weekend market update for the week ending Sunday, January 12th, 2025. My email address is hgsidoc@gmail.com. For any questions, concerns, feel free to email me anything constructive. Please also put in the remarks of YouTube, whether positive or negative. What else? Click on subscribe, and you'll get these in your YouTube feed, and if you hit the alarm, it'll tell you when I post them. Special welcome to any of the new folks I met at this week's event that I was at in Tampa for VectorVest. VectorVest is an interesting program. They do a lot of work with some derived values that come from the charts, but you're able to scan and come up with a lot of things independent of the charts. It's just fascinating. I've had their product for a long time. It's always nice to go to their Tampa meeting, which can be seen on YouTube and probably can be found on YouTube, that they do every year, the first weekend after the first. I titled this one, Markets Likely Bounce Soon. Should we worry about a bear trap? I really have a hard time believing that we are going to bounce, go on to new highs, and Shangri-La, no problems. I think we are in a tough market. I think the Fed can certainly prop up the market by talking up rate cuts, and then they get data, whether it's jobless, jolts, employment rates, and they right away the market sells off because it acts against the Fed's ability to cut. This week we got CPI, PPI, and a bunch of other data, so get ready for the ride. So again, should we be worrying about a bear trap? I think so. This is for educational purposes only. Anything I recommend should be in the spirit of education, not investment advice. The intent of this video is to demonstrate the tools of top-down analysis and how I apply them. Trading involves risk. You and you are solely responsible for any investment decisions you make. I may own or intend to sell any stock mentioned in this report. Trading stocks and options should be considered risky, and you should consult with your financial advisor before making trades. And I have tools for multiple platforms, but I'm an independent trader. There is another event coming up starting on Monday called Wealth 365. I've had the opportunity, thanks to the graciousness of Rob Hoffman and his team, to present there. I'm not presenting this week because I'll be at JP Morgan Healthcare Conference all week. But even if you've been to these before, well, if you have been to these before, you know how great these meetings are. You'll have 40, 50 different speakers, really 8 to 6 or so every day. Rob going on to crazy hours talking. It's a great tool, and it's a great opportunity to learn. And if you want to you want to subscribe to it or buy any of the add-ons, it's the best time of year to do it. Since I'm not speaking, if you have interest in my add-on, just email me at hgsidoc@gmail.com. I can hook you up with the seminar offer. If you like these videos but they're too long, that's cool. I get it. My wife says they're too long too. And so does my son. But you can find me most mornings at stocksanddocs.com. The asterisk is I travel a lot, and when I travel, I can't always do them. Now, what I recommend you do is join my Google group. It's called Top Down Trader. Why should you join it? What are the benefits? Every night I put out a video. That video is typically 15, 20 minutes. It's more in depth than the Stocks and Docs video, and it's less long than this video. I use various platforms. I use it as a vehicle to support the different things that I do and to teach. Why else? You'll get access to a live meeting, which will be on the 25th of January, when I'll be launching one of my new tools called Market MRI Pro. And I'll be going through 3 hours building the case of why top-down investing makes sense and how I use the different tools. Those tools will be Wealth Charts, Metastock, HGSI, TradeStation, TradingView, Metastock, and my new app. So it's free. It's no obligations. You don't have to have bought something from mine before. You don't have to come to my live meetings. It's for anybody that can put up with my ranting and raving. And you just go to Google Groups, search for Top Down Trader, and join. Major markets tell the story. Because of the special holiday on the 9th, it was a 4-day week, not a 5-day week. But what we can see here is that over the past 5 days, the major indices in yellow were all negative. You could see on Friday they were extremely negative. All of them, the yellow ones minus 1.6 and worse, minus 2.2 for the Russell. In orange, you could see that the equal weight spider was a little worse and the equal weight NASDAQ was a little bit better. So really no differentiation for the equal weight. If you hear funny noises, I apologize, but my 3-year-old lovely granddaughter's decided that I'm her favorite person today. So she keeps coming around, which is always a good thing. So basically, markets weak on the week, especially weak on Friday. Interestingly, the small cap growth was flat over the 5 days, but it was down big. I'm looking at the 50, down big on Friday. Leadership is commodities, natural gas, which we've talked about a lot recently, breaking above its 200. Oil, commodity, silver, gold make up the top. And similar to the 50, ARKK was actually up on the week, but down significantly on Friday. If we look at sectors over the last 5 days, only sectors up were energy, healthcare, materials, and you could see the only sector up on Friday in the S&P 1500 was energy. This is a Q-Edge tool. It is using the S&P 1500, not the 500. You could see in the 1500 you had 1 out of 11 sectors positive with 91 negative, and the only one up again was energy. 14% of the industry groups were up, and 15% of the stocks were up. It was a very, very negative session. If you made money, it's because you were either in cash, had contra ETFs, or happened to have picked stocks in the right industry groups, because for the most part, things were down. You could see that in this tool, we're starting to pile up stocks below the Bollinger Band, which is one of the signs of where we're getting close to a reversal area. If you look here, you could see sectors, industry groups, and stocks, and they've been weak now for a month. So we've had periods where the market rallied, but when you put it all together, the markets are in a rough period, and over the last month, one sector positive, only 8% of the industry positives, and 15% of the stocks. Now, I usually go the Q market breadth, but I have a problem with it. It's got nothing to do with the tool or Sagar. Metastock is changing downloaders and download vendors on their end of day, which I need to populate this, and they don't have IXIC, NYA, and several of the NASDAQ, especially the smaller cap ones. So this is not really useful. But what it did show is we had a distribution day on the NASDAQ, which is why I wanted to leave it here. If we look here, looking at the NASDAQ versus the NYSE, we had a distribution day here. And notice this green line, how it's getting in the reversal area. When it gets up to the top, the market's too rich and the market usually comes down. When it gets to the bottom, you get to an area where you're getting close to a place where for no more than just technical reasons the market rebounds. And then if you look over here, and again, issues with the data vendor, you could see across the board diamonds, Russell, NASDAQ 100, SP 1500, and the SP 500 are all bouncing around that area. And if you look, for example, in yellow at stocks above the 50, we are at the lowest we've been going back quite some time. So there's a lot of technical reasons why we should expect a bounce early in the week. If we look at my timing model, not so good. In fact, it deteriorated significantly this week. I've got 3 negatives on the weekly. I've got the S&P went negative, meaning the stock closed below the WMA and the weekly bongo turned red. Both have to occur at the same time. The diamonds went negative for the first time in a while on the weekly, and they joined the Russell, which has been negative for the last month. The only index holding up at this point is the Qs. Now, 3 out of 4 being in sell, it's hard for me to want to take a lot of new positions here. I believe we're getting close to a bounce, which means it's hard for me to take a lot of short positions here. And you could see here the 3-month or 13-week new high, new low really coming down to areas where you almost always see it reverse. The daily, all of them have been in a sell signal. They still are. And why do I think even if we get a rally? Well, imagine that this was a full chart. You had a trend line up here. You can rally significantly on each of these without changing the narrative of lower highs and lower lows. I think we rally this week at some point. I hope we rally. We don't have to rally if we get news that is worse than expected or the economy is too strong. We don't have to rally. But I think the thing is, I don't expect us to hit new highs. I expect us to pull back into the trend lines and fail again. Hopefully I'm wrong if you're long. If you look at performance on Friday, you can see all the major ETFs that we track here were negative except for the VIX, which is up. If we look at what was the leadership, the only green sector was energy, and the only two green in my themes was oil and gas and gold miners, commodities. And over here you can see very few sectors, one sector in the S&P 1500, one in the NYSE, and one in the NASDAQ were up. The others were down. Industry groups 16% up, 14% up, and 16% up. So most of the industries, regardless of index, were down, and only advancer stocks 15%, 22% on the NYSE, and 21% on the NASDAQ. That is a very tough market. If you look at the 5-day performance, you can see over here where it is, not as bad numerically as Friday, but still negative, and still the only thing is energy. And over here on the 5-day, so on the 5-day, the leadership of energy and healthcare, and then materials and industrial, all of which are laggards over the longer period of time. And then down here you got telemedicine and digital, gold, biotech, copper, transport. So maybe there's some rotation coming here. Maybe this will be good for the market. Rates rise, as you could see here. In white, the 10-year was up 4% on Friday, 3% on the 30-year, and rising rates, especially at this level, as we get closer and closer to 5%, are going to pressure the stock market. Do we have a recession coming? Well, I think we do. I think it's pretty clear going back to 85 that whenever you cross back from an inverted yield curve to above it, you get the gray bars. Those gray bars are recession, so why would this time be any different? I learned a long time ago that the kiss of death to an investor trader is thinking that this time is different. And so we have inverted and then normalized on both the 10 minus 3 month, 10 minus 2. Those are things that lead to recessions. Doesn't tell you when, and you could see it's often a lag between the cross and the recession. Things that might hint us that something bad, we might see the credit tightness pop up, which we're not seeing, and we might see a drop in economic activity. Clearly, we're not hearing that. This coming week, we'll get the next update in the Philadelphia Diffusion Index. You don't get recessions unless you're below minus 20, and we're not right now. Breadth approaches the bounce zone, not necessarily stocks above the 200. This is one that's still holding. But when you look at stocks above the 40, and then here's Warden's interpretation, and everybody uses a different index or a group of indexes to track it, but also showing that we're getting to the point where we have so few new highs, we must always bounce at this level. If you look at the buckets, 80% of the stocks in the S&P 1500 trading below the midline of their Bollinger Bands. That's bearish. And again, here 17% in Edge Rater, stocks in the S&P 1500 below the bands. I've seen 30 and 40 and 50. I've seen 90%. But unless you're in a super bear market, 2025 is usually where we start to reverse. So we could be a day or two away from that bounce. In my new tool, I break out the NYSE, the S&P 1500, the NASDAQ Composite, and the Russell 2000. And you can see I'm actually tracking a little bit higher on the individual indices. So we are at a point. Maybe ignore the index for a second, but look at the underlying stock market. The market's at a point where reversal's probably close as we get deeply oversold. We haven't had a Hindi in several weeks, but their damage is done. They signal a top. They don't always work. We're getting that sell-off, whether it's because of the Hindenburgs or the Hindenburg is just measuring that underlying market where a sell-off is possible. And what I want to just point out is we're growing the new lows, and that's something that I'll be watching because the new lows could get to the 15-25% range before we're done. Markets were negative on the week. You could see if I take all the stocks, $2.5 and 250,000 shares, assign them an ERG, which is the earnings per share rank, relative strength rank, and group rank, you can get up to 297. And you could see if you take away the tail and the head where there's very few stocks, pretty much flat and negative across the board. If you look at here, EPS rank versus gain, stocks that made money actually did worse than stocks that didn't. If you look at relative strength versus gain, people lost less with good relative strength, so very mixed there. And here it tells me that the stocks that were distributing beginning of the week actually exceeded those that were accumulating. Here is a large list of either from Investors Business Daily, from HGSI, from TradeStation, various different educators, my own stuff, scans I do, and then watch lists that I follow. In blue, you can see my watch list. The top one is my current holdings, filtered buys, and then buy watch. The S&P 1500 is here, and then the growth MarketSmith 50, IBD 50, and the weekend review are in yellow. For the most part, growth underperformed. If you're wondering why I was less negative, because I started buying contra ETFs. I've been liquidating stocks as I've been talking about raising cash, and I built a contra ETF position. Unfortunately, I sold some of my dogs just because sometimes it's hard to make money in those because when you get ready to sell, the market goes the other way. I would have made more had I held my contra to the dollar. If you look at the news and earnings for the coming week, there's a whopper news. You got PPI, you got CPI, you got jobless claims, you got housing, and you got a bunch of Fed heads. And you got that Philadelphia Diffusion Index on Thursday as well. So you got a lot of news to whipsaw this market. And earnings, not so much, but we're going to start to get a sense of what's going on with banks as we get to the end of the week. Citibank in the middle of the week, Wells Fargo, BlackRock, JP Morgan. So this will be a very interesting week. As I say in the lower right-hand corner, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. Thoughts: closed at losses at the index level. Rising rates were probably the reason. We have sticky inflation, not stick inflation, and higher rates for an extended period of time can't be good. 10 yield, 2 yield, they all surged this week. Economic data for the most part came in stronger. Um, most stocks were down. As I've mentioned several times, I see multiple signs that tell me that we could have a bounce this week. But I got to wonder if we get any kind of a bounce, is it just a bear trap? And I will tell you that some of the greatest rallies that I participated in my 3 decades of in the market were bear market rallies. So just because we bounce doesn't mean we're going to go off to nirvana land. I've been raising that's a band, cash, closing long positions, and have bought enough contras to mitigate, protect my longs. I'll play any rally we get, but my expectations we're likely to see a lower low before we see a higher high. On to the charts. Again, daily videos at Stocks and Docs. And please join my top-down trader. It's the only mailing list I'm going to be using because that one doesn't come back to me as being potential spam. And I do got some really cool things coming down, and I got great feedback on the nightly videos. And you can always quit if you don't like it. And by the way, it don't cost anything. We're picking the date now for the June meeting in Anaheim. That will happen this year. And I am going to very aggressively try and find space in early December to have a meeting here in Florida. All right, let's take a look at the programs. We'll go into wealth charts and let's take a look at the indices daily. A sec. All right, let's go to the spider 5 minutes. So 1, 2, 3, 4. We gapped open on Monday and kind of got above where we were before the quote Santa rally time, which last 5 days of December, first 2 days of January. Traded up for a couple hours, and then the market sold off the rest of the week. And I could try and feel good about the fact that we didn't break this area of lows on Friday, but the bottom line is you could almost draw a trend line here. Um, a rough week, no matter what you say. If you look at the batch of different ETFs, you could see they're all overlapping here. So it was a rough week across the board. If we look at, that's the E-minis after hours, but it doesn't matter. Let's go to the Spider Daily here. You can see we're breaking down. Now again, if we were to rally, and I'm not a perma bear, not a perma bull. I'm a top-down guy that trades the market I have, not the market I think we should have. I think the odds are we rally into this area and then we break down again. So I need to see more than just a one-day rally to believe that this is different. This is the daily spiders on Friday, gap down 1.5% on the week. You can see the spiders had a bearish engulfing pattern, down almost 2%. That is not a bullish pattern by any means. If I look at the Qs broke the line in the sand, the 50. That's concerning. No, they broke it. They closed near the low of their session. So the Qs on Friday were down 1.5. They may just rally up to that 50 and fail. On the weekly, a bearish engulfing pattern, down 2.2%. Diamonds breaking down and really been falling ever since setting a high up here. On Friday, down 1.6%. And when you look at the weekly, which the 50 would be support, bearish engulfing, minus 1.83. The Russell has made it down to the 200, which is a potential target for all of them, and it held. That could be optimistic if it can go higher from here. And the January effect favors small stocks. But on Friday, the Russell was down 2.2, and on the week, bearish engulfing pattern, down 3.39. So it's hard to be optimistic when you look at that picture of the markets. If we look at volatility, we'll look at the VIX weekly because it's done by now. What do we see? The VIX was up. It was up 21%. Not a shocker, as the markets are sort of reeling right now. And then if we look at the dollar, now I think I've sorted out why the futures and the dollar look different, and why is it important. This is a key area of resistance, and it's held for quite some time, as you can see here. And what I wanted to show you is we have run right up there, and then we got this big gap down. Now, I would have thought that would have been great for the markets, but I think that was a resetting of some of the futures and the relationships that occur every January. Because if I look at, for example, the dollar futures, I'm in that zone up here. This is an important zone. Rates are bad. Rates are a problem. Dollar may like high rates. If the dollar does not stop and start to pull back, more reason for the market to be worried. In fact, since this is a daily chart, let's just see if I can get this to happen. Let's put the spider. And we'll do that as a separate add as ratio. No. The spider typically pulls back when the dollar's high, pulls back when the dollar's going higher. It hasn't pulled back yet the dollar's pretty high. So I think the dollar remains a headwind in this market. Commodities, Let's go to the right tab. The gold broke above the 50. A lot of the gold stocks started breaking out. Unfortunately, many of them breaking out from areas below the 50. Silver is going to have to get through the 50, but moving as well. Oil, big gap up, closed middle of the program. Kind of ran into this resistance area from that prior close. It'll be interesting to see if oil can break out from here, but it was still a very strong session. Oil was up 4.32%. Natural gas is starting to look like it's real. We talked for a long time about how it kept failing at the 200. We wanted to see a breakout, retest, and go higher. We got it. Maybe you should be long UNG or Boyle or some of the energy plays that are more natural gas-like. Now, it looks like my data feed does no longer work for the 10-year SME. So that's something that I will figure out, but I'll tell you we know from other programs that the 10-year is up. We already looked at the market timing, so we don't need to look there. Let's look at the hourly sectors. These are, except for the lower left, these are S&P sectors versus spiders ratio charts, and we're looking at performance. And the last day is going to be this red line. Where you're pointing, if you're up here, is strength, down here is weakness, and we could see a major change right away. Technology sold off hard. Discretionary, although it doesn't look bad, has come off its top. Even communications is eased. And are we seeing rotation into staples, utilities? Maybe. Real estate, not so much. Discretionary here, still looks okay. It's just come down much. Healthcare is making a move. No surprise, it usually goes up before the JP Morgan conference anyways. Materials making a little bit of a move. Energy looks okay. Nothing is a superstar here. Of course not. The only market up was energy. If we go into the scanners, let's start with the heat map and look at the ones that everybody cares about. NVIDIA, false breakout and breaking down here. Now, is it broken? No, it's not broken. It is below the 50, and that's concerning. It's sitting right on this line here, which I think, I can't remember. No, it's just the closed line. My bad. So NVIDIA, it's concerning because it broke down, but it's not broken. It's still, it's still going to be a bellwether. Do I think it's going higher here? No. I think that we could bounce around in this area between 120 and where we're at. But if this market was to go higher, NVIDIA is probably going to turn around and lead it. Tesla, got to break the trend line, probably heading towards the 50. Meta looks perfectly good. Shouldn't be hard to clear the prior highs. Apple, similar to NVIDIA, broke down below the 50. It's not over, but it's troublesome. Amazon, heading towards the 50, not broken yet. Microsoft, broken down below the 50 and below the 200. That one's kind of worrisome looking. Google, still very healthy. And then Netflix, the one that has such great seasonality this time of year and whose earnings are coming up. Kind of disappointing to see Netflix pulling back like that. Sign of the market. If we look at the wealth scanner, let's see if anything in the I can buy territory makes it up to the top. Because we have not seen that for a while. We've been seeing bonds, short treasuries. Only thing at 800 or above is U.S. oil. Then we have short treasuries, Israel, natural gas, technology, space exploration, gasoline, gold miners. Still heavy commodities and energy starting to make its play. If we go into the CAT scanner, I might want to go look at energy. So let's just look at the energy list. And let me tell you what I do here. I don't want the futures. I want energy. What I do here is I have a number of preset scans that allow me to look for characteristics of stocks, of different stocks that I like to buy. I prefer to buy stocks that are in uptrends that pull back and buy them when they start to go again. So we have a number of scans that we've made for that, and this is it right here. So if I look and apply it to energy, HP, this is a services company, clear downtrend, still below the 200, no. Tallow, similar story. Coterra, which I think is more of an integrated play, it's kind of interesting. Downtrend is now broken above the 200. Gapped up. I don't like how it closed, but that one looks interesting. Look at relative strength in OBV. Devon, yeah, it's breaking out, but it's still well below the 200. EOG, one that I, at least in my mind, associate with natural gas, and one of the ones that might be interesting if natural gas is truly breaking out. Big bar on Friday, but a long-legged doji is all we got. And RES, they make some of the steel pipes. Not that exciting. If I go into momentum up, let's see if I see anything with four dots. Now, the fact that all these stocks showed up here tells me there's a lot of momentum and energy. SSL, a international integrated, kind of in a big downtrend. Talos. So what you see is that these may be interesting plays, but you're buying them off of pretty depressed levels. Eventually they go higher. Is this the right time? I don't know. I don't follow them that closely. Let's take a look at the weekend review list, which includes the combo list and a few more, and what comes up to the top. Because I think we'll find in the first couple of stocks some actionable stocks. AIV, Apartment Investment and Management. It's kind of loosey, flat. ARHS, Our House. I don't know what they do. I don't like buying things below the 200, but this wall of volume that's coming in has perked my interest, as has the volume breakout momentum dots, the PSCR reversal, and the great relative strength in OBV and not extended. I need to change something here. Sometimes my EMS signal loses its shape. It's supposed to be a triangle. Triangle up. Okay. And let's do the sell. Triangle down. Excuse me. Hit apply. Good. So you could see that, and again, I don't even know what they do, but sideways movement, lots of volume coming in, which is bullish. Three dots, relative strength at OBV. 20% away to get to that 200. So I do some research. That one doesn't look bad. All right, what else we got? One of my favorite utilities, Constellation Energy. A beautiful breakout. So you've got it all. You've got what Morales and Katcher termed the Bible gap up, which is a strong breakout, one that has good history of going higher. You've had great volume coming in. You've broken out above the prior highs. You've got momentum higher. You're getting extended, but not to the point now where I couldn't buy it. It's still below 95. And look at this relative strength in OBV. I like CEG. Delta, all-time high. Buyable gap up. All-time highs, they usually go higher as long as this market doesn't kill us. Look at its earnings. $1.85 versus $1.76 versus a prior year $1.28. 5% surprise. They got rewarded. Don't know anything about Precision Biosciences. There's going to be a lot of small biotech names popping this week with news at JP Morgan. Royalty Pharma. Interesting company. They buy rights to a lot of drugs that are already marketed. They give the company cash, which usually those companies might need, especially a small company, and they get a long-term royalty free. Well, that's a beautiful breakout. Been in a long-term downtrend, but this is an impressive move. Again, not extended to the point where I can't buy it. Look at the relative strength in OBV. Oil, USO, keeps going higher. Walgreen Boots Alliance, you look at their earnings, I bet they don't look good. Let's see. Well, 51 versus 37, that looks really good. The revenue showed a huge loss. They basically threw the babies out with the bathwater to clear their books. And, I think that for 25, I'm going to be looking at Walgreens and CVS as being potential reversal plays. And I may put a small amount of both of them away. They're not growth. They're not high flyers. They're not things that I'm certain are going higher. But these are two franchises that have too much value to be beaten up the way they are. American Airlines, wow. You remember old Jimmy Buffett saying, how do you get to become a billionaire? You put 2 billion in an airline and you have 1 billion left when you take it out. Nice little consolidation, cup and a handle and a breakout. I like American here. There are a lot of things. Oxygen had earnings come out. It was interesting because the original conversation I heard wasn't that great. Um, 7 cents versus a penny, but you could see they did nothing, and then all of a sudden they got upgraded because of earnings. You could see the volume that came in. I wonder if they're a takeout candidate because there was a lot of excitement with them on Thursday and Friday, partly why I had a good week. There's so many stocks here considering the concerns that we live in the bigger world. I don't know NBIS, but it's been getting a lot of talk this weekend. So it's an IPO pullback and breaking out here. That actually looks interesting. Let me show you some of the stocks that I put on my buy list. A lot of retail. VFC. It's cold. People are buying winter jackets. Pretty nice little pattern here. And sort of a sideways movement and a big move off of the 50 with good volume, breakout momentum, relative strength, and OBV look good. On Cloud, ONON, On Holding Corporation. Large move, pull back to the 50, and then a breakout with big volume on Friday. I like that. Oh, I don't remember what I liked about this one. Let's see, ARIS. Is this Aris Water Solutions? I think this one pays a dividend too. But big move up, pull back to the 50 and a reversal. That is a hammer, and this is a big day taking out the 50 and the 17. Now, just because I like them doesn't mean I'm buying any of them. I'm going to be watching them. With what's going on in this market, I'm not going and chasing fireflies. ANF, nice base, looks to me like it might be setting up to run. Look at the volume that just came into it. A stock that I personally got to experience, Intuitive Surgical, as I had some surgery this year. And, I'm a doc, but I haven't practiced in a while. But when you're an intern and a medical student, you experience a lot of different things. And with the surgery I had, I expected to be out of work for 6 weeks at the minimum. And I was ready to go back to work in 4 or 5 days. I'm sure it was the robot. Um, Minimal scars. They don't even send you home with pain medicine. It's bizarre. Big run up, sideways move. Looks like it's getting ready to run again. And all of these are really subject to the market. I think we bounce. These are things I might be looking at. I am not expecting a big run here. LRN, educational company. Don't like the shooting star formation, but you can't argue the fact that pulled back to the 50 and broke out. SN, Shark Ninja. This stock had a huge uptrend, and then it took a breath, pulled back, and it's had a breakout off the 50 with good volume, good relative strength, good OBV. INTA, IntApp, pull back to the 50 and a breakout. That's what I like. XL, this is a biotech whose drug just got a label extension, which means more sales. I can't believe nobody's bought this one. From a takeout, pull back to the 50 and a breakout. Those are my favorite patterns. Let's look at BBB. This is called BBB Foods. Not my type of company. And why did I pick this one? Pull back. Just looks like it's running again, and it took out the 50 with breakout momentum coming out of squeeze with good relative strength. And lastly, ARLP. Are we getting ready for coal? Pays a big dividend. Pull back to the 50, breaking out here. So I'm a top-down guy. Market, risky. I expect a bounce. Maybe not Monday or Tuesday, but I'd be surprised if we don't bounce before the week is over. The counter is too many news things. If we had a soft CPI or PPI, we're going higher. But I'd be concerned about it being a bull trap. Industry groups, man, there's not a lot of industry groups working. Commodities are leading. Semis probably still have some opportunity. And stocks, I just gave you a handful. To the downside, boy, it was easier to find shorting candidates than it was to find buys this week. Um, and so there were things that I looked at that were shortable, but this is the kind of market that if I'm going to get a rally, probably not going to be chasing my shorts. Um, you look at something like Axon, big leader, selling off, failed at the 50. BlackRock, and God we trust, and BlackRock pays for it. Big run up, breaking down. Is it going to come down to the 200? Clorox, defensive play, Clorox, breaking down. Um, PayPal, breaking down from the 50. Roper, super expensive electronics stock, really breaking down. So I think there are some opportunities to the short side. I saw some I liked to the long side. I think right now probably the easiest thing is to hold on to what you got and see what happens over the next couple of days. I would not be chasing everything because I want to see the market rally first, and I don't know if and when it's going to happen. But I won't get too overexcited with the rally because I think it's going to be a bull trap. Please join Top Down Trader. Enjoy the Wealth 365 event. And remember, everything we talk about here should be considered one thing, and that's education. And we'll see you next weekend.